Welcome to Common Fund Institute Online, dedicated to the advancement of investment knowledge and the promotion of best practices in financial management.
Hi, everyone. Thanks for attending the Venture Workshop. My name is Dave Shaker. I'm an Associate Director at CF Private Equity, responsible for venture investments. And today we'll be talking about venture capital. So to get started, we're showing here the three principles of endowment stewardship. There's equity bias, liquidity premium, and diversification. Today's segment will be focused on the latter two buckets with a specific focus on venture capital. So within that, how do you determine the right venture managers to back? Access is critical, as we'll see in venture, even more so than in other asset classes, focusing on ways to determine what's the appropriate fund size or sector focus, and then making sure that you are capturing risk premium and alpha by choosing the correct set of managers and figuring out what your exposure looks like from a bottoms-up perspective. And we'll talk about what venture means and how to do that in the context of your broader portfolio in this session. So taking a step back and kind of level setting around what venture capital is, I think is a good place to start. And so what we've shown here is an illustrative depiction of the different stages of venture over time. So venture capital can mean a lot of different things, whether you're looking at the earliest stages of company formation. Let's say it's two people working on an idea in a garage, don't have revenue, don't have customers. That can be considered venture capital, but so can companies that are on the cusp of being public that may have billions in revenue. And so where you are on that spectrum is very important because there's a different risk and value associated with each stage. So what we've shown here is that path over time for a typical company. So the nomenclature in venture starts with a seed investment, seed being the first round of capital that the company takes on its way to growing. And then you can see that it turns into a letter. So Series A is then the next stage, and then Series B is around after that, Series C, Series D, and so on until eventually the company exits, whether that's going public, which is the initial public offering, an IPO, or an exit, selling to a strategic acquirer, so M&A. And everywhere on that line, you have different risk rewards. So what we've shown here is two blue lines. The darker line is the value of the company over time. And then the lighter blue line is the inherent risk of that company over time. So you can see at the seed stage, at one extreme, the risk is extremely high. Most of those companies don't end up being successful. But the value of those companies at the time is very low. So when you think about how much you stand to gain from a seed investment, that's the maximum kind of return that you could get investing at the seed stage and then experiencing all of that growth over time. So the risk reward there is quite high. Conversely, if you look on the other end, all the way on the right at the later stages, an IPO timeframe, the value is pretty significant. So most of the value has already been realized by the time you enter at that stage, and the risk is inherently lower. So you wouldn't expect as many failures at those stages. And so where you are in that spectrum makes a big difference in terms of the risk in your portfolio. Where we tend to focus and where most venture managers tend to focus is in the middle. So really Series A to Series D tends to be the main focus areas where you have a nice complementary risk return where the risk has been lowered significantly from the seed stage, but there's still some risk. And then the value, importantly, hasn't increased as much as it does in the later stages. So you still have a lot of value appreciation that you can capture with minimal or de-risked risk on the downside. And so that's where we tend to spend our time. The last thing I would say on this slide is when you make a venture investment, they tend to be longer in nature than other investments like public investments or like secondaries or even buyouts. And so when you think about the time it takes for a company from inception to eventually going public, it's typically about 10 years, which we've shown on the bottom of this page, with about 5 years to exit from being at that mid-stage Series C to eventually going public. So when you make an investment in venture, you need to think about the longevity of that investment, the time it takes to get your capital back. It is a little bit longer than you'd see in other asset classes, but at the same time, the value appreciation is also a lot greater if you make a successful investment than it would be in other asset classes. So that's important to keep in mind as well when you think about the duration of your investments. So hopefully that's a good overview of what venture capital means, this page shows why it's important to pick the right managers. So what we're showing here is the top quartile, median, and bottom quartile across different asset classes. And you can see with venture all the way on the right, the first thing that jumps out is there's a very wide spread between the top and bottom quartile. It's much wider than public equities and fixed income, and even wider than US private equity as well. But you can see that if you are able to generate top quartile performance in venture, it outpaces the annualized returns of any other asset class. Conversely, if you have bottom quartile performance in venture, you're not getting compensated for that incremental risk that you're taking. And so that's why it's important to think about manager selection, being with the right managers that generate top quartile returns. As we'll talk about, there's a persistence of top quartile returns in venture, meaning the top firms tend to continue to operate the best, continue to find the best deals. That's not the case in other asset classes. So when you think about a venture portfolio, you really want to emphasize being with the managers that have shown the ability to generate returns before. At the end of the presentation, we'll talk about ways to diligence that, but access is really key in venture because that's how you get towards the top of that range versus towards the bottom. So with that, maybe we'll talk about the market environment. There's certainly been a lot of change in venture and volatility, and we have a few slides to hopefully make sense of some of that. So starting here, what we've shown is the public multiples for software companies, which is a really good proxy for what's happened in venture in terms of valuations. So obviously, after the COVID pandemic really hit us in 2020, you saw a run up in technology across the board. If you think about it, we were using tech a lot more in our daily lives, in our professional lives as well. Everyone was working from home. And what you saw was technology companies had a pull forward of revenue. So they ended up growing 2 or 3 times more, for example, than they thought they would grow during that year. And public investors rewarded those companies and thought maybe that was a new paradigm. Everyone was shifting to technology. Maybe it would stay that way. Maybe those growth rates were sustainable. And what you saw was the revenue multiples increased because of that. So you can see on this line graph here, the jagged line is the revenue multiples over time. And it went from a 10-year average of about 10 times revenue, meaning the market cap's about 10 times revenue, going to north of 20 times in a very short time period. Obviously, as we know, that wasn't sustainable. The world shifted back to in-person. Some habits stayed, but technology companies grew slower than they did during that time period, and the revenue multiples went back down. It may seem like it was a precipitous drop, but if you look at it in a historical context, it's really a reversion to the mean, to the historical average. Where it is today is about 8 or 9 times, and if you look at the historical context of 10 times, it's pretty reasonable. And so we think that this has been a shift back to rationality, with the last couple of years being the anomaly, and now we're sort of back to where it was before that time. If you look at what that means in terms of private companies, it's relatively the same story. So what we're showing here, the line graph is the same line graph that we showed on the previous page of public multiples. The bar graph is showing the median private multiple for late stage deals. If you remember back a few slides ago, late stage is sort of that Series D pre-IPO range where the value is pretty high relative to the risk. What we saw is a pretty steep drop off in valuations of late stage private companies. So if you look at the bar charts, really in Q1 of 2022 onwards, you started to see significant declines quarter over quarter. One thing that's not captured here is that many of the deals just weren't happening. So there's some noise up and down quarter to quarter. That's because there were very few deals in the data sets. Most deals were not happening. Companies didn't want to come to market and raise at down rounds or lower valuations than they raised before. Those that did come back typically saw that they were getting a lot less credit for the revenue than they were in the previous market. And so that's what happened in the late stage. This is the same graph, but for the early stage. So this is the seed Series A stage. And so what you see here is there was some decline as well, but it was less pronounced than the late stage. So we're showing the same, again, line graph showing public market revenue multiples. In the early stage, the bar graphs, it definitely went down along the same time period, but it was less pronounced, maybe down about 30 to 40%, whereas late stage was down 50 to 70%. And so when you think about what's happening in venture, you need to bifurcate between what's happening in late stage, where there was a lot more of an impact, in the early stage, which was more muted. And this is a pretty good explanation for why there's such a big difference. So what we saw was an influx of non-traditional venture investors entering the space. Non-traditional means they aren't your kind of long-term venture only focused managers and funds. They're funds like sovereign wealth funds, buyout funds that started doing venture, hedge funds that started doing private venture investments, corporate venture investors as well. And they poured into the market in a big way. You can see on the left side of the page, what we're showing here is the dollars invested in venture from non-traditionals, which is in blue, and the traditionals, which is in gray. And you can see in the 2013 timeframe and before that, which is not on the page here, it was about 50-50. But that changed in a big way. If you look at the more recent years, it was as much as 80-20, 80% of venture dollars being invested by those non-traditional investors. Why does this matter? Non-traditional investors typically are less price sensitive, and they're focused on the later stage. So what you saw was a huge run up in late stage valuations, driven by investors that aren't as savvy in terms of underwriting returns and thinking about valuations for venture companies. And what you saw was they entered the market because we were in a prolonged low to no interest rate environment. They were trying to generate alpha by digging, going a bit earlier, digging into kind of early stage companies that they wouldn't have looked at in the past. But then once interest rates started going up again, they were treated kind of just as quickly as they came in, which we're showing on the right here. So if you look at non-traditional dollars invested, it dropped off pretty significantly after 2021. You can see it reached a peak of $80 billion invested in that quarter by non-traditional investors, which is a staggering number. If you think about venture broadly, it's a relatively small market. So if you pour $80 billion in a quarter, that's going to change a lot of things in terms of the pace of deals, the valuations of deals as well. But we saw pretty quickly that it normalized to the point where it is, today as of Q3, 26 billion. So about a third of where it was before, which we think again is a healthy reversion back to the historical mean. If you look at deal value over time, it tells the same story. This is a good kind of summary page of what I was just talking about, where deal counts are back to normal, deal value is back to normal. Clearly, looking at the long-term trend, 2021 and early 2022 were the anomaly periods. So we think now is, again, a rational environment. And if you look at, in terms of managers who's benefiting from all of this change, it really is the established firms that are in a better position today than they were a couple of years ago. And the newer firms are the ones that are more challenged. So what we've shown here on the left is how many new managers enter the venture space every year. If you looked at past years, from 2015 to 2021, it's been about 200 to 300 new venture firms a year, which is, again, a pretty staggering number in a historical context. But if you look at where it is today, in 2022, it was about 141, so it dropped by more than half. If you look at it this year, and this is through Q3, we'd expect it to be even lower than it was last year. So it's been much harder for new entrants to just spin up a venture firm and start investing. There is an LP appetite for that. And when you look at where the capital is going, this is capital from LPs, where it's going to different firms. On the right here, 73% of it is going to established firms, meaning they're on a fund 4 or greater, which generally means they've been around for 10, 12 years or more. And then emerging firms, which would be a fund 1, fund 2, or fund 3, they're getting a smaller and smaller percentage of LP dollars, at 27% today. If you looked at it 5 years ago, again, it was about 50-50. So we think that's important. It's important to work with established managers that have seen cycles, know how to navigate the bad times as well as the good times. And we're seeing that play out, where there's clearly a flight to quality from the LP perspective. One of the things that's sort of up in the air is the exit market. venture is highly dependent on having a healthy exit market. Again, going back to the first slide, companies as they grow have the ultimate goal of exiting, and that's either through a public offering, an IPO, or through an M&A event, getting acquired. And so you can see historically M&A has been by far the largest source of exits, 92% year to date. But if you look historically, it's really in that 90% range of exits end up being M&A versus IPOs. But IPOs end up being much bigger. So when you look at what's contributing to the value of exits, which is on the right, it's basically flipped. 85% of the value created was through IPOs in 2021. And it's really been majority IPOs historically. So certainly the IPO window needs to be open for venture to be attractive. And so we've seen some green shoots with that recently, with Instacart, for example, going public a quarter ago, and some companies sort of waiting the wings, ready to go public. But that it's dependent on that turning around. But M&A is still a relatively strong exit path for these companies. And if you think about who the likely acquirers are, venture is tech oriented by nature. And when you look at the global tech companies, they're sitting on unprecedented amounts of cash. This shows they're sitting on $8 trillion in cash across the top 10 global tech majors, which is, again, a staggering number. And presumably some of that will be used to make strategic acquisitions. So the exit market has some signs of turning around, but it's definitely something we're looking at. And then, we're obviously in a correction right now. Have been navigating through it. So we wanted to look at, how does this compare to past corrections? And what it really comes down to is these companies are much more scaled and much more stable than the venture companies of the past couple of corrections. So if you look at, for example, the number of IPOs that have happened of companies that are doing more than 100 million in revenue, so what we would consider a scaled company, there were 0 of those types of companies going public in 2000 during the dot-com bubble, and even in 2008 during the global financial crisis. Whereas if you looked at the last couple of years, you've had 50, 60 plus companies at 100 million or more go public. So these are really scaled, stable businesses. If you look at the time it takes to go public and the profile of companies when they go public today, they're about 3 times bigger than they were back in 2000, and they take twice as long to go public as well. There are a couple of ramifications of that. One is, these companies are a lot more stable. From a public investor standpoint, you're buying into companies that probably aren't going to go away overnight. But then importantly, when you think about a venture allocation in your portfolio, in 2000, it was pretty common to see a company go public right away, and then most of their growth, you could still capture that by just being invested in the stock market as a public investor. So if you think about Google, for example, they were started in 1998. They went public in 2004 at about a 25 billion market cap. Obviously today it's north of $1 trillion. So all of that valuation growth accrued to public investors. Today, though, what we see is most of the kind of high potential category defining businesses are getting to significant scale in the private market. Stripe is a good example. If you're not familiar, they power the back end of making payments online, which is obviously a huge space. They're nearing $100 billion valuation, haven't gone public yet. So a lot of that value is accruing to venture investors instead of public market investors. That's the sign of the times that we're in. That's why it's important to have a venture program to capture that growth. 2 more pages on the market, which I think are interesting. One is just that innovation persists regardless of macro conditions. So what we've shown here is, how the market has trended over time, a lot of ups and downs. Obviously, you see a couple of troughs here, one in the 2001-ish timeframe, and then one in 08, 09, which is the global financial crisis. But what we've shown here is when all of these marquee companies were founded, and you can see that there's no real correlation between what's happening in the macro environment and what's happening in company formation. And in fact, if you just look at the last correction around 2009, you had 2 marquee companies founded during that time, Airbnb and Uber, which ended up being 2 of the largest exits in venture over the last 10 years. So what does that mean? If you looked at the market turning in '08 and said you didn't want a venture program because it's quote unquote risky, you would have missed out on the opportunity to invest in those two companies and a handful of others. So it shows that you need to really be consistent to capture innovation. Founders aren't necessarily looking at what's happening to interest rates or economic policy. They're more focused on an idea that they have and they want to build it kind of regardless of what's happening. And we've seen that play out time and time again. And the last piece I'd leave with on the market, which kind of ties things together, is we looked at what happened during the last correction, again, that the '08 timeframe, and looked at performance across the venture industry pre and post that correction. So what we're showing here is on the left, what's the aggregate performance of all venture vintages that were founded between 2006 and 2008. And then on the right is aggregate performance of all vintages from 2009 to 2011. And then we've shown, again, the top quartile, the median, and the bottom quartile for each of these. And you can see across all the quartiles, performance went up by about 50% in the post-crisis vintages, just as a function of when those funds were invested. So that tells a pretty stark story. Your post-correction, you're getting more bang for your buck. Valuations came down, there was less competition, there was a flight to quality again. So, you saw a lot of proven managers having good funds during that period, whereas before you had some good funds and some not so good funds. And so, this is not necessarily a prediction, but it is a pattern that we've seen play out over years of data across the venture industry. So when you think about where we sit today, kind of coming out of a correction or still in the middle of it, it could be a relatively attractive time to have a venture allocation based on what we've seen in the past. So that was a little bit about the market context. I think the other piece that's important to consider is the opportunity set. And where we sit today within venture, there hasn't been a more exciting time to have a venture strategy, just given all of the technology advancements that are happening and the pace of disruption as well. So venture, as I mentioned, is really an index on technology. If you believe that we're going to use tech more as a society, as businesses, you should play it by having a venture strategy because that's the way to capture that tech innovation at the ground level. And so what we've shown here are a few kind of macro stats that show why technology is important and why it's growing. So the first on the left is showing the digital economy as a percent of US GDP. Obviously, a lot of large digital businesses have been created since 2005, but what we're showing here is at a broader context, we're still relatively underpenetrated technology as a percentage of the total pie. It's really gone from about 8% to 10% of US GDP, which sounds like it hasn't been a lot of movement, but obviously this is all trillions and trillions of dollars. So the market is massive, but the point here is that there's so much more room to grow. 10% isn't the high watermark for our ability to use technology across different industries. If you look at what industries are being disrupted by technology, it isn't one or two different things. It's multiple sectors. So whether you're in financial services or energy or healthcare, education, what have you, there's a way that technology is impacting the way you do business, or it could present a fruitful way to drive more efficiencies and more profitability or revenue growth at your companies, organizations. And then the last piece here on the right, which is showing that it's a strategic priority for C-level executives, regardless of industry. So what we're showing here is some market stats from Gartner. So for example, there's $5 trillion in global IT spend. It's still growing about 8% on a very large number. So there's a big market there. 80% of enterprise buyers expect to deploy AI, for example, in 2024. We'll talk about some of the investment themes. That's a big one. It's clearly top of mind for most companies. And then more than half of C-level execs expect their tech budgets to actually increase despite overall spending coming down because they see technology as a way to drive more efficiency, ultimately reduce costs as well. And so when we think about drilling in a little bit more into what the different sub themes are, there are a lot of different trends that we think are interesting. And this is a pretty unique time. It hasn't always been like this. If you think back to the mid 90s, for example, the big theme was the rise of the internet, right? And then if you think back to the late 2000s, the big theme was the rise of the iPhone and all of the different things that could be created around it. And then even 5 years ago, it was really about the shift to cloud computing. So not having a data center, a physical data center on premise at your company, but you could rent space that someone else is managing, and it reduced all these capital expenditures. Today, all those themes are still alive and well, but you have so many more platforms as well, like artificial intelligence and like blockchain, that are quite exciting. So won't go through all of these in detail, but enterprise software remains probably the biggest market when you think about venture opportunities and where managers are focused. So I mentioned $5 trillion in global IT spend. Really only 13 to 15% of that is on the cloud today. If you think about the fact that pretty much all of it can move to the cloud, that's a lot of market cap still to be created, just in kind of core enterprise software that seems like it's been around for a long time, but has a lot of room to grow. Healthcare obviously has undergone a lot of change and stress to the system over the last few years. And so we've reached a unique time in the healthcare industry where payers, providers, and practitioners all kind of realize that healthcare needs technology to evolve. A lot of hospitals, for example, are running on different systems that don't talk to each other. There are a lot of ways for telemedicine to help reduce on-site visits, and ultimately lead to better patient outcomes with less cost. Right now, healthcare accounts for 20% of US GDP, and outcomes aren't necessarily getting better. So looking at technology to help solve that. Similar issues with logistics and supply chain. A lot of global supply chains were fractured in recent times, and so companies are looking to technology to understand how their inventory is moving across the globe, ways to optimize their supply chain and infrastructure, and ultimately save time and money, which is a common theme across all of these. And then there's some more kind of bleeding edge, cool new technologies. So frontier and deep tech is a good example, where we're seeing robotics and automation now across a lot of businesses. Think about warehouses, for example, that are entirely run by robots, where they can basically take commands and be able to go find and package inventory and ship it around the globe without a human physically handling the goods, maybe a human oversight, but most of that is happening in an automated fashion. Think about that across a lot of different types of use cases. Electric vehicles obviously are becoming more and more penetrated, but also the use of drones for things like surveillance or even commercial uses like last mile logistics. Think about drones dropping off an Amazon package, for example. If you have that across a lot of different vendors, all the opportunities that could unlock. Consumer is still an attractive segment. It has been for a long time, but if you think about some of the more viral channels that get a lot of engagement, like TikTok, for example, the amount of commerce that's transacted through that, and the ability to really use that as an advertising mechanism that's free, and the ability to change the unit economics of a lot of consumer businesses by achieving that kind of virality, is changing the game for a lot of consumer companies and making those investments more attractive than they have been. And then finally, touched on it before, but new computing platforms. Obviously, artificial intelligence is kind of the most hyped and most excited category today. I would say our managers and managers across venture have been focused on AI for some time. It really reached the public forefront or lexicon with ChatGPT, which some of you may have used before when it was released last year. But really think about the ways that could unlock more efficiency within organizations. The ability to have it automate some of the more mundane tasks and free up people's time to work on more high value projects. We're seeing that play out already, and a lot of consumer use cases as well. A good stat as far as that goes is one of the most famous cohorts of accelerators. They help new companies get up to speed, is called Y Combinator, and in their most recent class, more than half of their companies are focused on AI or have AI in their products somehow. So it's definitely something that's going to come up, and has the ability to really disrupt a lot of different categories and unlock a lot of value. There was a McKinsey report, for example, that they think AI could unlock $15 trillion in incremental GDP. So think about what that could entail in terms of new companies and their ability to scale. So a lot of exciting things happening in venture. So when you combine kind of the more attractive valuation environment, less competition, with the opportunity set being broader and deeper than ever, all signs kind of point to having an attractive couple of vintages. So now let's shift to kind of how you do diligence on a manager. Venture sounds great. How do I pick the right horses to back, the right managers to back? So there are a number of different considerations that you should go through when thinking about adding a manager to your asset allocation. And part of it's quantitative, part of it is certainly qualitative as well. So when you think about structuring your due diligence, you're really looking at 7 different pieces that come together to formulate a recommendation. So the first is obviously figuring out what the thesis is and what the risks are. So you want to understand the managers intimately, understand what they've done well, understand things that they can improve on. A lot of that is through time spent with the managers. So we, for example, typically take a year or more to really understand what managers are doing, get to know them well, understand their pros and cons, and make that really really obvious to our internal investment committee, outline the things that we'd like to see them do better, the things that we think make them unique. And so you always want to orient what you're doing around bullet point 1 there. Bullet point 2 really helps inform that. So understanding the team and firm history. We talked about how established managers tend to perform better and are more resilient during economically challenged times. That's something important to understand, how they manage cycles in the past. Do they have kind of the consistent returns that you're looking for? Have they been able to navigate team changes successfully? That all goes into the second point there. Point 3 is really to understand what they're focused on and whether they are skating where the puck is going, to use an analogy. So what's their strategy? What are the themes they're investing in? Do they align with the themes that I just went through a couple slides ago, where we think the opportunities are? And then what's their ability to source? Are they finding deals that others aren't finding? Are they finding marquee companies before everyone else? Are they doing something unique, like whether it's partnerships with research labs or universities, or they put on a demo day, for example, that attracts a lot of talent? There could be a lot of different flavors of having competitive sourcing, but you want to understand what the X factor is there. And then value add. So how are they actually helping these companies? Are they very active board members, or are they passive? Are they rolling their sleeves up and helping on specific projects and being involved in the day-to-day, or are they kind of sitting back and offering to introduce customers but don't really follow through on that? So you want to understand the next layer of how they're actually helping these companies and changing the expected probability of success for their companies. And then the fourth one is really where the quantitative piece comes in. So performance benchmarking and portfolio analysis. So you want to understand what their performance looks like over time. How does it compare to other funds' performance of similar vintages? Would it be accretive or dilutive to your existing portfolio? Those are the types of things you dig into there. And then the fifth one is where it becomes a little bit more qualitative, which is we do referencing. So ideally you could talk to other LPs that have invested or have passed on the manager you're looking at, and understand the kind of unfiltered version of why they made those decisions. Referencing other GPs. So for example, if another firm that shares the same company with the fund you're looking at, you might want to ask how they've been as board members. Have they been helpful to that company? They'll usually have good insight. And then to the extent you can, doing referencing with founders of companies that have worked with that manager in the past to understand how they've been helpful or ways that they can improve. And then the next two are sort of more clinical, more process, but understanding key terms and key changes and doing a legal and risk review as well, which is just as important to kind of spot red flags Um, and that kind of wraps up the 7 investment considerations. Maybe it's helpful to walk through a straw man of how we would go about doing that. So, going through each of these, one, we want to be able to track, monitor progress, and identify differentiation. And so a lot of that is based on materials that the manager will give us. So they always have a data room that'll have a number of different documents in it. So you want to go through an initial review of those to understand those questions. And then you want to really drill down into, is this team uniquely qualified to execute on the strategy? So that's where you kind of digest the materials that you get, and then you have pointed questions, and you will set up diligence calls or meetings with the GPs to ask those questions over time. And then, ultimately you're trying to project whether the manager will be accretive to your fund or to your portfolio. And so you want to do returns and portfolio analysis, which is sort of what I talked about on the previous page, where you look at performance over time and how it compares to what you have and how it's compared to other firms of the same vintage to make sure you're getting the best manager. And then, a lot of it is reputation based. So number 4 is the manager access constrained and well regarded in the space. That you really get from referencing. You can sort of get a sense for how people talk about a firm or GPs at a firm, and that helps inform your perspective. They may not get through the materials that they give you. And then, looking at kind of the legal review, does it provide any benefits outside of kind of the core numbers, the core performance? So maybe they introduce you to other firms as well. And then ongoing monitoring. Really trying to understand if you can build a relationship over time. Venture is not a space where you write one check and then sort of forget about them. These are long-term relationships, sort of like a marriage. So when you make an investment, that fund typically has a 10+ year life. And the expectation is, you're going to continue supporting that fund over time because it's going to continue delivering returns, making good results. The reality in venture is when you make a commitment, you're not going to know if it's a good or bad commitment for a pretty long period of time. And so you want to make sure you have a strong relationship, understand their motivations, understanding if they're able to generate consistent performance over time. And that really is predicated on building a relationship. So that's, again, why it's important to do that diligence up front. We, for example, wouldn't commit to a manager that we've never met before unless we do a significant amount of work to understand how they think, how they operate, and build that trust, which is ultimately the most important thing. In terms of post-commitment, how you monitor your portfolio, this is a straw man of how we look at it, which is maybe helpful as you think about setting up your allocations. So really, you want to do a bottoms-up analysis of the commitments that you make, and then make sure it matches your top-down objectives. So that could be across a number of different factors. So what we're showing here is vintage year. So for example, you don't want to make all of your commitments in the same vintage year. As one extreme example, you have a lot of exposure to kind of what's happening at the time in the venture market. So you want to have diversification of vintage year. So we've shown here, we have 3 years, for example, in a given fund that we commit over 3 years. So yours might look a little bit different, but it's important to understand what vintages you're committed to and having vintage diversification. Geography as well. So some people or some managers will be focused on one specific geography. Some will be mostly in one geography, but dabble in others. Some have a more predetermined split across geographies. So you want to understand what that looks like and what that means as a part of your entire portfolio. So we look at what our exposures are to different geographies. And, we, for example, want to be about 2/3 in the US and 1/3 outside of that. So that's what we're always managing to. And then industry breakout as well. So, we tend to be more technology agnostic. So most of it's technology, but some portfolios may want more of a healthcare lean or more of an ed tech lean, let's say. So you want to make sure you're backing managers that are doing that as a big part of their portfolio and understand the look through of what that actually means in terms of how much healthcare exposure you have or how much ed tech exposure or fintech exposure and so on. So this is a helpful way to kind of track this. This is something that we model and track every week as we make commitments. And then the last piece I'll leave you with is just understanding how to model your commitments. So I touched on this a bit at the beginning. but these are long-term commitments. When you make a commitment to a venture firm, they're investing in early stage companies that will take 5+ years to eventually distribute cash back to you. So when you make a commitment at, let's say, year 0, typically the way it's structured is that firm will then invest that money over the next 5 years, maybe 6 years. And then years 7 to 10, let's say, are really when the harvesting period happens, where you get distributions back. So it's important to understand that venture takes patience more so than other asset classes because of the longer duration. But if you look at rates of return, you're more than compensated for it if you're working with the right folks. But it's important to understand that if you have a consistent venture program, you may be making 2, even 3 commitments to a venture manager before you see capital come back from your first commitment. So from a cash flow perspective, that's something you need to be aware of. And with that, that is all the content. So thank you again for attending the session.